In this video, we will listen to the earnings call of LandBridge, the latest quarter, so Q4 2024, March 6, 2025. We will listen for the earnings call. The earnings call is 40 minutes long, so please take a glass of tea, take a glass of water, take a cup of tea, a cup of coffee, take anything you want, and I will comment on the things I find interesting for this call. So I hope the audio will work fine. You will tell me in the comment section if it doesn't work well for you, and I hope that's fine. So we are here for a long video, guys, and I will stop along the way if I have to say something more. Okay.
Thank you for standing by, and welcome to the LandBridge fourth quarter 2024 results conference call. All lines have been placed on mute to prevent any background noise. After the speaker's remarks, there will be a question and answer session. If you would like to ask a question during this time, simply press star followed by the number 1 on your telephone keypad. If you would like to withdraw your question, again, press star 1. Thank you. I'd now like to turn the call over to Jason Long, Chief Executive Officer. You may begin.
Okay.
Good morning, everyone, and thank you for joining our fourth quarter and fiscal year 2024 earnings conference call. We continue our exceptional growth trajectory in the fourth quarter of 2024, growing revenue 109% and adjusted EBITDA 108% year over year, with an 87% adjusted EBITDA margin. For the full year ended December.
Just in case you didn't watch my video from yesterday I released a video about the analysis of this report, like revenue, earnings, adjusted EBITDA, some adjustments about the business. So in case you have not watched my video from yesterday, please watch it because I won't talk much about the numbers here.
31st, 2024, we grew revenues 51% year over year, adjusted EBITDA by 55% year over year, and achieved 88% adjusted EBITDA margins. As we reflect on our first 6 months as a public company, it is clear that our active land management strategy is working as expected to create value for our shareholders. 2024 was a year of expansion for LandBridge. We more than tripled our land holdings, growing our total surface acreage from approximately 72,000 surface acres to approximately 273,000 surface acres, with 53,000 of those acres acquired in the fourth quarter alone. In December, we acquired 46,000 largely contiguous surface acres known as the Wolfbone Ranch, which expanded our position in Reeves and Pecos counties, Texas, a highly strategic location for oil and natural gas production that also provides us access to the Waha natural gas hub. As part of the acquisition, LandBridge secured a minimum annual revenue commitment of $25 million for each of the next 5 years from VTX and its affiliates, which includes surface operations, brackish water, and royalties from produced water handling. We continued that momentum into 2025, closing on an acquisition in February for approximately 3,000 acres contiguous to our current land position in Lee County, New Mexico. This acquisition increased our current acreage position to approximately 276,000 acres. Additionally, we see significant future growth opportunities from digital infrastructure, renewable energy, and commercial real estate. Subsequent to the quarter, we executed 2 notable agreements. We executed a development agreement with Western Midstream Partners LP, providing a surface and pore space solution for a portion of the recently announced Pathfinder produced water pipeline and related produced water handling facilities on our East State Line Ranch. Additionally, we executed solar energy project development agreements with affiliates of Desiree, a leading developer, owner, and operator of renewable energy projects. The agreements include 6,700 acres in Andrews County, Texas, and Lee County, New Mexico, for which Desiree has submitted interconnection requests to the Southwest Power Pool. We're excited to be able to announce these 2 agreements that speak to our continued success to actively commercialize our land.
Yep.
We remain confident that digital infrastructure will be an important growth driver for our business moving forward. The rapid development of AI and related need for data centers, among other high computing power demands such as crypto mining, will continue to require access to cheap power and water for cooling.
Yeah, there was an interview made by David Capobianco, chairman of LandBridge, saying that they want to use all their lands to have what they called powered lands. So they are ready to host some things, to welcome projects, infrastructure, data center in the project. And if you look at the next 10 years for LandBridge, 20 years for LandBridge, the business model will not change. They have the lands and they say, yeah, welcome guys, put your data centers here, put your solar panels over there. That's fine. And they will have 90% margin. So the vision in the long term for LandBridge is crystal clear. They want to have powered lands. And this is exactly the thing they are talking about. They are building this, exactly this. The vision is quite clear.
Our acreage in West Texas is well positioned to support these requirements and will remain actively engaged in seeking potential opportunities with these interested parties. As a reminder, in November 2024, we officially signed our first lease development agreement for the development of a data center and subsequently received an $8 million payment in December. The payment is a one-time non-refundable deposit for a 2-year site selection period with the potential for a data center to be constructed within 4 years thereafter. The success of our IPO, the increase of our surface acreage, and the signing of new commercial agreements speak to the momentum of our active land management strategy.
Yeah, I couldn't care less about the $8 million payment in December. That's just a small check to sign the agreement, but nothing big. What I want to see for the next 2 years is the development of this data center. If it works out and if they have some comments to say about how it's working. Do they have some issues? It's the first one, so yes, they will face some issues. Is it easy to build? Do you find some potential headwinds that you didn't think of? Some unexpected problems? And if in 2025, 2026, these guys stop the agreement, they just say, oh no, we don't want to work with you, LandBridge, that's a huge bearish argument for the company, for LandBridge. So I hope this goes through. Let me continue.
Scott, now over to you.
Thank you, Jason, and good morning to everyone joining us today. To echo Jason, we're pleased with the results this quarter, proud of the milestones we reached in 2024, and excited for the promising growth opportunities ahead in 2025. Our fourth quarter revenues increased to $36.5 million, up 28% sequentially and 109% year over year. Our full year 2024 revenues increased to $110 million, up 51% year over year. Sequential revenue growth for the fourth quarter was driven by surface use royalties and revenues, which increased 54% sequentially, including the $8 million payment related to the data center lease development agreement Jason mentioned, as well as increased produced water royalty volumes. Revenue from oil and gas royalties also increased 54% sequentially in Q4, driven by an increase in net royalty production. Resource sales and royalties declined 28% sequentially, which is driven by a decrease in brackish water sales and royalty volumes.
Yep.
As highlighted the past few quarters, we continue to shift our revenue mix towards non-oil and gas royalty-based arrangements to further insulate our exposure to commodity price fluctuations.
This is what we talked about yesterday in our video about the earnings report. They just want to move away from the oil and gas industry, and this is working well for the moment. Nothing to say about it.
In the fourth quarter, non-oil and gas royalty revenue, including surface use royalties and revenues and resource sales and royalties, accounted for nearly 90% of overall revenue, approximately flat from the prior quarter and up about 20% year over year. For the full year, non-oil and gas mineral royalty revenue represented 85% of total revenue, an increase of more than 13% year over year. Importantly, our results in 2024 validate our ability to capitalize on growth in the Permian Basin without incurring meaningful operating and capital expenditures. This key feature of our business model translated to an adjusted EBITDA margin of 88% and free cash flow margin of 61% in 2024.
Yep, no capex for this business. And this is also something I didn't address for the video of yesterday. And this is how to think about valuation for a business that doesn't have any capex, right? If you invest in Microsoft, Google, Amazon, Meta platforms, you will have a certain amount of cash flows at the end of the year. And maybe 30% of the cash flows will have to be reinvested into capex. Maybe half of the free cash flow will have to be put into capex. For example, Google is producing a lot of free cash flow, but the capex is really high. So let's say 50% of the free cash flows are going into capex. What is the free cash flow you get as a shareholder? You only keep the remaining 50%. So maybe if you adjust the valuation on a price to free cash flow basis, maybe you want to adjust the capex part. So as a shareholder, you only get the remaining 50% of the capex of the free cash flow that is not reinvested as capex. But for TPL or for LandBridge, there is no capex. So all the free cash flows that the company generates is going to you, to your pockets, the shareholder. So maybe they deserve a better multiple on the price to free cash flow basis. And now we said it on the video yesterday. I estimated the price to free cash flow of LandBridge to be roughly 40. Yeah, I mean, I don't see this as very expensive based on this free cash flow model. And this is also what Horizon Kinetics is saying for TPL and LandBridge. I just stole their point, their arguments. This is a good way to think about free cash flow generation. If you want to know more about this, check Horizon Kinetics, this fund.
In the fourth quarter, we delivered $31.7 million of adjusted EBITDA, up 27% sequentially and 108% year over year, with an adjusted EBITDA margin of 87%. For the full year ended in 2024, we delivered $97.1 million of adjusted EBITDA. We also generated free cash flow of approximately $26.7 million and a free cash flow margin of 73% in the fourth quarter. And for the full year ended 2024, we generated $66.7 million of free cash flow. As noted last quarter, our free cash flow in 2024 was impacted by non-recurring IPO-related expenses and lease termination costs. Our Q4 free cash flow margin of around 70% is more in line with our long-term expectations. Additionally, we'd like to discuss our surface use economic efficiency, which we define as total revenues less oil and gas mineral royalty revenues divided by the applicable acreage. This metric for our legacy 72,000-acre position has increased from $465 per acre in 2022 to $724 per acre in 2023 to $1,018 per acre in 2024.
What's that? Okay. First, they said something about the free cash flow margins, which they expect to be higher than 70%. Great news. I mean, no surprise at all. We already knew that. We'd like to discuss our surface use economic efficiency, which we define as total revenue less oil and gas mineral royalty revenues. Okay, divided by the surface, the acreage. This metric on our legacy has increased. So for the first lens they had before the acquisitions, before 2024, they had 72,000 acres of land. On this lens, this metric, that's not the revenue per acre, was that the economic use efficiency? Is it that can be associated with the revenue per acre, but that's less oil and gas mineral royalty revenues. Okay, let's say it's kind of a revenue per acre. So it's all about efficiency, right? You want this to be as high as possible. It was like $500 in 2022, $700 in 2023, and $1,000 in 2024. Major increase. It's double in 2 years, 3 years. That's fine. I mean, this can grow 24% per year. Pretty bullish. It's all about efficiency. And I made a video a couple of weeks ago comparing the efficiency of the lens of LandBridge with the efficiency of the lens of TPL. And the conclusion was that LandBridge is much better at land efficiency compared to TPL, because that's the way the lenses are built, right? You have contiguous lens that one after the other side, compared to TPL, Texas Pacific lens, when you have a checkerboard kind of lens, a little bit over there, a little bit over there. So it's much harder to become efficient when you don't have contiguous lens for TPL. Pretty good news for LandBridge, saying that they are profitable, they are more efficient with all their lens, and you can expect the same kind of growth for all the acquired lens they had in 2024. Pretty good.
We think this speaks to our unique ability to significantly increase cash flows on our acreage over time through our active land management strategy. And we believe similar growth potential exists on the surface acquired in 2024, again, without any meaningful cash outlay for capital expenditures.
Yep.
Moving forward, we will continue to execute on our capital allocation priorities, which include pursuing value-enhancing land acquisitions with a focus on underutilized and undercommercialized surface.
Yep. You buy cheap lands that are vacant without any commercial use. You buy the lands and then you put your infrastructure, you work it out as they have done in the past, and then the value of the land is increasing. Basic stuff, and they've been doing this for so many years.
As a reminder, we seek to acquire surface that is not just financially accretive, but also offers long-term growth potential that mirrors our existing portfolio. We are also focused on maintaining a strong balance sheet to maximize financial flexibility over time. We ended the year with $385 million of debt outstanding under our credit and debt facilities, which is up from $281.3 million at the end of the third quarter of 2024. We updated and amended our debt facilities in part to fund our recent acquisitions. As part of the amendments, the requirement for quarterly amortization payments was removed, which will improve cash flow and liquidity to allow for more flexibility and optionality for future capital allocation alternatives. As a result of these updates, we ended the year with total liquidity of $107 million, including cash and cash equivalents of $37 million and $70 million available under our amended revolving credit facility. Finally, similar to last quarter, we've declared a cash dividend to shareholders of 10 cents per share. While we revisit the amount of the dividend on a quarterly basis with our board, we'll continue to focus our capital allocation strategy on a robust pipeline of attractive acquisition opportunities available to us.
I like it. Their first priority is acquisitions, smart acquisitions, which was not the case when we took a look at their investor presentation. Look at this. Yesterday, we saw this chart, this slide, disciplined capital allocation, and the first one was the debt structure. The second one was buybacks and dividends. And the third one was M&A. But now when they talk about their calls, in their earnings call, they say first the priority is M&A, which I like. I would have hated if they started talking about buybacks or dividends. So I like it. This is in line with what they have said before. M&A, growth, accretive land acquisitions.
Looking ahead, we are reaffirming our previously announced guidance for 2025. For the full year, we expect 170 to 190 million of adjusted EBITDA, driven by incremental contributions from our recent acquisitions, initial solar facility contributions to surface use revenues, and growth of surface use royalties through higher produced water volumes, among other factors detailed in our press release. In conclusion, we delivered another outstanding quarter to close out a year of strong growth. Our momentum remains promising, and we look forward to advancing development on our surface acreage in partnership with industry-leading developers and operators. And now we'd like to open up the line for questions. Operator?
Okay, now Q&A time. Q&A session. Some analysts from Wall Street and other funds will ask some questions. In past calls, we had some superstars, famous guys that asked questions. We had Larry Goldstein from Santa Monica Partners, one of the oldest shareholder of TPL. This is a guy that has a fund and has bought TPL 70 years ago. So he's an expert. So he asked a question about LandBridge, so he's getting interested in LandBridge. You had a couple of guys from Wall Street with great funds. And I don't know what kind of questions we can expect, to be honest. Any future plans of acquisitions? Obviously, I guess somebody will talk about the data center projects. I don't expect anything from data centers, to be honest. At least you have one guy that signed one data center project, so that's good enough. Come on, that's the first one, and they told us, yeah, we need at least 2 years, and after this 4 years, so it will take time to implement and create this data center. So calma, as we say in Real Madrid. So we'll see. By the way, if you're looking for a complete framework to analyze stocks and build a strong portfolio, I have a coaching program. More on that at the end of the video. Let me start.
Thank you. We will now begin the question and answer session. If you would like to ask a question, please press star 1 on your telephone keypad to raise your hand and join the queue. If you would like to withdraw your question, simply press star 1 again. Your first question comes from a line of Jackie Koletas from Goldman Sachs. Your line is open.
Hi, good morning. Thank you so much for the time. First, just want to start, you called out your ability to increase surface use economic efficiency year over year. Just looking ahead, where do you think this metric can go from here as you see the growth across your footprint?
Good question.
Yeah, hey, good morning, Jackie. It's a great question. We haven't defined a hard cap by any means right now, but we think there's still a lot of room to move that up. And just to quantify that a bit, we can look at a section or 1 square mile, 640 acres as a good example. And, in that section, we can fit, a one produced water handling facility that can generate $1.5 million per year at that facility in royalty revenue. But then on top of that, there's a lot of acreage that isn't used by just that 10-acre produced water handling facility site that we can do quite a bit with. I'll give an obvious example. We can fill in, call it that extra space with opportunities like solar, similar to the opportunity we announced on this earnings release, and that could add easily another $500,000 plus, across that section. So to think we can do $2 million per section or per square mile, which equates to a little over $3,000 an acre, I would say is very, very achievable. And that's not giving credit to some of the more, call it economically dense opportunities, such as sand mines, such as digital infrastructure, and so on. And so a lot of running room left.
So their target can be roughly $3,000. And now it's $1,000. So are they saying that they can triple the efficiency of their current land? If this is what they are saying, this is really bullish. And they don't give us any timeline. I guess their timeline here is a few years. They doubled their efficiency in 3 years. Maybe they can double it again in 3 years. I don't know. It can be like 2,000 in 2027. So maybe this target of $3,000 of revenue per acre is by 2030. Okay, good enough.
Again, I think that 3,000 plus is a pretty good bogey here in the near term, but we definitely don't think that's the hard cap.
In the near term? Yeah, okay. Well, anyway.
Got it. Appreciate it. And then just following up, on your agreement with Wes, can you provide just more details on the size and expected upside from that contract? And then are there more third-party agreements that you can win from here beyond, WaterBridge in general?
Yeah, good question. So to start with the West piece, the agreement is a bit bespoke, just given the fact that we are a portion of the solution there, albeit we think that we're one of the critical pieces of the solution. In terms of just the economic impact, we expect to get just low single-digit millions in terms of surface damages, rights away, and those types of payments here, over the next 12 to 18 months as they work out the construction of that asset. Once everything is operational, we could see high single-digit millions to call it low to mid-teens of royalties. It really just depends on the total volumes and the source of those volumes. But I would say a good deal for us, a good deal for Wes. We're happy to partner with them on this, and I think there's a great upside for both of us here. Now, as it relates to the second part of the question, we are in process in talks with a lot of other folks out there, a lot of third parties out there. So, this Wes agreement is certainly not just call it a one and done. Obviously we have a lot going on with WaterBridge, but there are a lot of other folks in the water infrastructure space and the upstream space that find both access to our surface and through our surface incredibly valuable. We continue to have those commercial discussions and hope to share more wins later this year.
Well, thank you. I'll leave it there.
Thanks, Jackie.
Your next question comes from a line of Charles Meade from Johnson Rice. Your line is open.
Yes. Good morning, Jason and Scott. Jason, I want to go back to I want to go back to some of your prepared comments on the data center. First, it was great, and you guys have been talking about this for a while. It's great to see that $8 million in December. But can you? I think if I heard you right, you said you got a 2-year site selection period and then a 4-year construction period. Can you give us a sense of the what the roadmap is from here? What the milestones would be for future revenue, and whether there's going to be anything when we exit that 2-year site selection period, and then what the along the lines of what Scott was saying, what the kind of annual revenue opportunity is perhaps after that 4-year construction period.
Yeah. Hey, Charles, I'll tackle this one. So as we've mentioned previously, this 2-year option period or site selection period, kind of in the process of that right now. The voiceover to us has been expectations likely closer to 12 to 18 months, but they do have that full 24 months. After that site selection wraps up, we start to see called a ratchet of cash flows that work to our benefit. And so it'll start with a smaller, more subsidized lease component as they kind of stage for construction. But once they actually break ground on construction, we would expect to see that full $8 million a year in lease payments for that 2,000 acres. Now, as different phases come online, that's when we would expect to see incremental revenue streams to include the profits interest on the power generation, as well as potentially any water sales that are needed for cooling either the power generation or the actual data center itself. But as you alluded to, it is a multi-year timeline. These are large capital projects. And so, I think we're in a really good spot right now with everything moving forward as contemplated. But, I guess the takeaway is we would expect to start seeing more revenues from that likely next year and seeing those continue to ratchet up over the subsequent years through construction as different phases of operations come online. And I think finally kind of targeting again that 1 gigawatt being probably a few years after that first phase is online.
Yeah, okay.
Got it. I know. Thanks for all that detail, Scott. I know you talked about it before, but it's good to get that refresher.
Yeah, of course.
The Wolfbone Ranch. Can you talk about how that integration is going, and what, if anything, you've learned, and any kind of opportunities that you may be aware of that you weren't when you struck that deal?
Yeah, I mean, from an integration standpoint, the beauty of Surface, and again, not being necessarily an operating company, is the integration component is actually pretty light, other than just some back office work. And so, that has gone seamlessly. I would say kudos to both, our accounting and legal teams, as well as those over at VTOL and VTX. It was a very smooth process there. But I mean, as we kind of think through opportunities, I think what we've found is just a lot of the not necessarily the commercial underwriting, but the investment thesis that went into that acquisition. So proximity to Waha, large contiguous blocks, access to various infrastructure, highway frontage, all of that, is coming to fruition very, very quickly. And we've gotten quite a bit of interest in that, such we're having a number of conversations right now for access to Surface because of those various resources. So, obviously having just closed on that a couple months ago, we're still kind of in the early innings here, but, I would say it's somewhat off to the races, and we've got great traction, out of the gate here. And again, hope to be able to share some of the wins later this year as a result of that acquisition.
Come on, bring us some new questions, guys.
That's great detail. Thanks, Scott. Thanks, Jason.
Yeah, thanks, Charles.
Your next question comes from a line of Derek Whitfield from Texas Capital. Your line is open.
Good morning, all, and congrats on an impressive first year as a public company.
Thanks, Derek.
First, I wanted to start with the land strategy on page 4. Previously, you were building a wall around the state line for the benefit of advantaged water captures. Northern and Delaware water disposal needs grew. Could you speak to the opportunity you're seeing with the BLM, SLO leases in Lee County?
So on the BLM and state lease stuff, majority of those acreage positions that we bought, obviously, were very strategic in the fact that it gave us the ability to bring some of our supply water from Texas up into New Mexico, as well as the produced water piece. So really leveraging on the fee pieces that we bought in and around those leases is where we've been able to get some really good tailwinds.
Yeah, I think it's important to note that we're not necessarily underwriting any value to those leases when we work through our M&A strategy. Now, just by nature of, call it, the New Mexico landscape, a lot of this fee surface includes some of these leases, so you tend to be able to capture those in one fell swoop, call it. But when we think through, like, where is the real value proposition in these acquisitions, it is going to be largely on that fee surface. For the sake of the math, we wanted to call that out just to be transparent with folks.
Yeah.
Terrific. And then perhaps bigger picture question on data centers for my follow-up. We've seen a trend of data centers being built in more remote locations like Stargate, and thinking about the progression of discussions with your customers, how are you seeing that picture unfold for more data centers in the Permian? I guess directionally, are you guys more bullish than 3 to 6 months ago?
Take this one, Jason. Yeah, look, I think that, we definitely are, I think, more bullish. I think that, timing is everything here. Once this first domino falls, I think there'll be a lot more to come with it. Power is a big piece of this, and obviously access to surface, access to the grid, access to gas are all very important pieces of the puzzle. So look, I think that the data center hyperscalers are definitely getting more comfortable with these remote locations, as we've seen on the Stargate side of things. So we're very excited about the opportunity. Our position and our surface gives us really good running room as we have these conversations.
Okay, nothing big, nothing surprising. They didn't scale back from the data center projects, and no particular bullishness over there. So it's nothing. The DeepSeek phenomenon hasn't had any major impact, I would say. Now there is a Stargate project. If it turns out to be right, the how do you call it in English? The mothership project. I don't know how to say it, guys. The mothership project is in Texas, right? The major build out for the major Texas data center. The main location will be Texas. So if a lot of data centers will be built in Texas, it will drive up sentiment for LandBridge. I mean, you have a lot of data centers in Texas, but maybe it can bring more demand for LandBridge, their land.
That's great. Thanks for taking my questions.
Yep, thanks, Derek.
Your next question comes from a line of Alexander Goldfarb from Piper Sandler. Okay. Your line is open.
Hey, good morning down there. Morning. Just a few questions. First, you guys are certainly blessed with a great cost of capital in your equity, but you also talked about restructuring your credit facility, I think, to eliminate amortization, go to IO. So I guess my question is, as you guys look at the landscape, certainly the market is placing a premium in your stock for data centers, but those deals take a lot longer cash flow wise to materialize versus water, solar, et cetera, that seem to be much sooner in monetization. So how are you guys thinking about the projects that you're looking at from a cash flow perspective versus the funding side where the market is paying a premium for the data centers, but those take longer?
Great question.
Yeah, I think that it's a good question. I think, you're spot on. I mean, the market is definitely leaning into the data center theme, not just for us, I would say more broadly to anyone who kind of touches at this point. The point I always make when folks bring that up is first, I think we're in a fortunate spot where that opportunity is very real for us. And we're obviously working through that. We've discussed that quite publicly, but totally insulated from that data center narrative is this core oil and gas story, or call it energy infrastructure and land story that you alluded to, that provides just substantial growth here in the near term. And I mean, we talked to the surface use economic efficiency metric, the growth there, spoke a bit about where we think that could go. And I think it's important to remember all of that is very achievable, outside of the data center narrative, which is only going to provide, further uplift as those come to fruition. And ultimately, when we think through our strategy and the action plan on our side, is all of the above. I mean, I think we've got these very real opportunities to grow cash flows here in the near term that, again, cost us no capital, that we are going to continue to pursue. Now, we're trying to be mindful about the opportunity costs of certain areas of our surface where, we think data centers could be best suited relative to some of the other opportunities. But at the end of the day, I mean, there is a lot of runway we have out there on the surface today for for opportunities outside of data centers, and we're going to continue to push on those, and those will be the driver of the growth that we expect to see here in the coming, couple of years.
Sorry, I had to check a message. I didn't follow. We're trying to be mindful of opportunity cost. Okay. Hey, is that a runway we have? Yeah. Basically, we will. Data centers are a bonus, are a plus to the investment thesis. But we plan to grow organically outside data centers. Yeah, okay. Perfect.
The data center, call it tailwinds, are very real. And we think, 3, 5+ years down the road, all of that will start to get layered on to the successes that we achieve, in a lot of these other things, a lot of these other investment opportunities. And so, I tell folks it's great because, we can increase, or we believe we can increase our cash flows by orders of magnitude outside of data centers. And I think we're executing on that. We're proving we're executing on that. There's a lot of runway left. The data center story is additive. And so the combination of those two things, I think, makes this a very, very powerful story in the market, which is why the market's received it the way it has. And it's on us to continue to execute on both fronts if we want to hold our ground here.
Okay, good.
And then along those lines, your funding, do you think that you'll go back and raise more equity, or you plan to...
Raising equity means issuing shares, like diluting shares. That's the reverse of buybacks. Okay.
Use debt, like what should we be modeling for capital raises for this year?
Good question.
Yeah, I think, if the right opportunity presents itself, we would raise equity.
They raised equity a little bit for an acquisition. I don't remember which one. A little bit. They diluted shareholders by a little bit. And that is at the same moment that they raised the guidance, maybe. I have a doubt. Early December, which means the stock fell 10% for some reason and then rebounded a few days after this. So it causes a lot of panic to raise equity, to dilute the shareholders a little bit. But maybe this is the cost of having such a high growth.
I think that said, we obviously generate an immense amount of free cash flow. I think keeping the balance sheet healthy is a priority. I mean, we're not afraid to put a little bit of leverage on there when it makes sense, but I think keeping a sensible balance is probably the best approach here. I mean, we're in a very healthy position, not just from a leverage standpoint, but just from a debt service coverage standpoint, and we want to make sure it stays that way. I mean, that will give us the ability to navigate, any volatility or risk that may come up in the future that's unforeseen at the moment. We like that. But for us to issue equity, it's got to make sense. It's got to have the acquisition opportunity needs to have a growth profile that we think, mirrors our own in attractiveness. And it needs to be a story that we can go out and tell the public, look, this is why equity makes sense in this context. And, there's no one size fits all. I think it's really going to depend on the situation, but ultimately maintaining a prudent balance sheet, making sure we're not diluting folks unnecessarily, but ensuring that we're staying kind of responsible in the full context of the company and continuing to drive growth. All of those aspects are top of mind.
Okay. I don't want any questions about the buybacks. I don't want them to say the word buyback. That's good. They just raise equity for growth. In the investor presentation, they had a chart about capital allocation decisions, and they said opportunistically return value to shareholders through various strategic initiatives, ability to repurchase shares. I don't want a question about buybacks. I want them to speak like this. Raise equity, growth, it must make sense, etc. For the moment, they have a very good track record of being smart when it comes to acquisitions. I want them to continue like this. If you can grow 40% per year, so be it.
Okay, and just if you'll, just one more question on the water needs for the data centers. And forgive me, obviously coming from a real estate side, not an oil guy. The brackish water and the water that you guys take from others who are drilling or fracking for oil. Does that brackish water, can that be converted to use in cooling data centers, or do data centers require pure, fresh, first generation water, if you will?
That's great.
Yeah, good question. So you've got just brackish water, which is not necessarily the same as produced water. So you've got your brackish water wells out of the ground. You've got produced water, which is coming up with the oil and gas. I think the latter certainly would require more treatment. There's likely to be some level of treatment for either, most definitely with produced water. And so I don't want to give the impression it's you just connect the pipe up to the data center and it's good. I think there would be some costs associated with getting that water to the quality that's needed. And all of that, is kind of taken into consideration as a lot of these data center developers and operators work through their diligence and underwriting. But I think that said, where we have a big advantage in West Texas is we have an abundance of these resources, both in terms of brackish water and produced water. And while there may be some incremental costs associated with treatment, there isn't, a large metropolitan area that you're competing with for these resources. And I think generally speaking, that is very attractive. Jason, you want to add? Well,
that's a great question. Will you use the produced water from drilling the oil directly to cool the data centers, because data centers produce a lot of heat. You need the cooling off. So that's a very good question, to have this virtuous cycle of water. Apparently, you kind of have a virtuous cycle. You can use the same water, but you need a little bit of treatment, which is a little cost, but that's fine.
One thing to be clear is that cost would not be something that LandBridge would. Great point. Yeah, great point. Yeah.
Okay, thank you.
Yeah, that's true.
Yeah, thanks, Alex.
Your next question comes from a line of Kevin McCurdy from Pickering Energy Partners.
By the way, this is what I love about TPL and LandBridge. If there is a change in infrastructure, if there is a change in technology, the way they drill oil, the way they produce a different kind of water, extract water, wind, solar, etc. If there is a technology change and the way we produce energy is changing, LandBridge will not have any cost. The people that take care of the infrastructure will have to suffer the costs. But LandBridge is just having the rent. They just have the lands. They don't incur any costs if there is a change in strategy, the way you use the water data center projects, because this is the beauty of this business model. This is a royalty play. They will not incur any costs if there is a change in infrastructure.
Line is open.
Hey, good morning, Jason and Scott. My first question is on the macro outlook and the impact on your business. Oil prices have kind of taken a hit over the last week. What oil price and corresponding level of activity is built into your 2025 guide, and how sensitive do you expect your EBITDA to be to oil prices this year?
Yeah, good question, Kevin. Good to hear from you. So no meaningful ramps whatsoever built into our 2025 guide. All that's based on firm guidance from operators we have, both on the WaterBridge side and others. And, I think generally speaking, as it relates to commodity price sensitivity, there would need to be a pretty massive swing to the economic potential for the Delaware Basin for that to move on track. Outside of our small minerals position, which is, we expect to be sub 10% of our business this year, we really don't have any meaningful commodity price sensitivity. So I would say, in summary, as long as the, commodity prices kind of hold to a point where producers continue with their development plans this year, as kind of spoken to the public, no real impact on us.
Yes, we talked about it yesterday. I showed you the percentage of revenue that came from oil and gas, and the conclusion was roughly 15%, right? Here we go. Oil and gas royalties, 14% of the revenue is coming from oil and gas. So if the price of oil goes down for some reason, you have a problem, a macro problem, the impact will be quite minimal. They will suffer in this small part, but it's not even 20% of their revenue. So the impact, as they rightly say, is minimal.
Great, appreciate that detail. And thank you for the earlier comments on the Western Midstream EBITDA impact. I wonder if you could share the same thing for the newly announced solar agreement, looking for any EBITDA impact and the timing.
Yeah. So for those deals, it takes somewhere between 2 and 3 years to get through the permitting and development. In that interim period, we get a smaller, we call it option fee, development fee, something to that extent. But 2 to 3 years down the road, once that comes online, we would expect a project like this, about 7,000 acres, 550 megawatts, to contribute, call it mid to high single-digit millions of cash flow per year.
Great, thank you.
Yeah, thanks, Tim.
Your next question comes from the line of Teresa Chen from Barclays. Your line is open.
Morning. You have been very busy with a flurry of activity within the last year, both on the organic and inorganic front. I wanted to ask on your M&A outlook from here, if you could just remind us, how fragmented is the market at this point, and are there still many areas of desirable surface acreage left near your footprint that would fit well within your portfolio?
Yeah. Hey, good morning, Teresa. We have been busy. No, I think to answer your question, there's still quite a bit out there. And I think that's, I alluded to that in the prepared remarks, from a capital allocation standpoint, M&A continues to be by a wide margin the best use of our capital. Generally speaking, the landscape is still very, very fragmented. There's still a lot of opportunities out there. And we're in talks with a number of those right now. I think, there is a real benefit that we bring to the table, particularly in opportunities where the surface owner may own the underlying minerals and wants to encourage more development activity on that surface. That's something we can bring to the table. Or in situations where a seller may have, tax considerations, the ability to do, a more tax-advantaged deal via our public currency is also another advantage that we have. And so, we continue to look at all the tools that we have to execute on our M&A strategy. We think that, again, the pipeline is very robust right now. We think there's a lot out there that makes a lot of sense and is incredibly additive to our platform. So we will continue to pursue those.
Understood. And on the topic of surface efficiency for the assets already within your portfolio and getting to that incremental 3,000 per acre target, understanding that some of it will be relatively capital light and some of these opportunities might be more involved. But when we think about the average going forward, how much CapEx do you expect to deploy in order to realize this target?
Yeah, I mean, just as a reminder, we don't do any of the developing of any of these assets whatsoever. I think for this upcoming year, we had expected somewhere between $1 and $2 million of CapEx total, and that's just kind of nickel and dime things on like trucks and other kind of field assets that we need just to manage the business. And so the beauty of the business model is, we acquire surface. We'll go through some of the efforts needed to make that surface commercially viable. That typically does not involve any capital. And then we go out and we try to drive business in that surface. From other folks looking for sophisticated landowners in the right areas who know how to work with them. And that has gone very, very well for us, and that has allowed us to drive that surface use efficiency metric on that Lake C position, up more than 100% in a couple of years. And like I mentioned earlier, we think that is a very replicable growth strategy on the rest of our surface. And so, there is a very long runway for us to continue to drive growth on the position as it exists today. Like I mentioned, we think that M&A is only going to be additive and going to help drive that growth. But the point I'd make is, outside of acquiring surface, all of that growth does not necessitate CapEx, which is, again, the beauty of the business model here.
Okay, if I remember correctly, they have $1,000 of efficiency revenue per acre, and they said in the midterm in the near term they expect $3,000. So a triple. Maybe they can do that before 2030. It will drive a lot of efficiency, a lot of new free cash flow.
Thank you.
Yeah, thank you, Teresa.
Your next question comes from the line of Roger Reed from Wells Fargo. Your line is open.
Yeah, good morning. Let me take a slightly different tack here, just with the Texas legislature in session and some of the water issues are on their agenda. We don't know exactly where it'll shake out, but is there anything you're watching there in terms of regulation that would be potentially enhancing for you or create an opportunity? It kind of ties into the earlier question on, what kind of water you need for a data center, because I understand some of the legislation or proposed legislation is about recycling water as opposed to just, permanent disposal underground.
Yeah, great question. We 100% are watching everything that's going on. Obviously, it not only potentially could be a benefit for LandBridge, but also the same with WaterBridge on the WaterBridge side as well. As you think through the recycling piece of that, which our surface position gives us a really good opportunity to take advantage of that opportunity, right? So you need access to large contiguous surface to create these recycling ponds and basically centers. So yeah, I mean, we do think it's a great opportunity, and we're watching it extremely closely.
And then one of the other things out there was, and this gets back to, the issue with some of the minor earthquakes out in West Texas, disposal of water from neighboring states, which in this case would obviously be New Mexico. Is there anything that you're looking at you might have to do differently, or that would force the industry to be more likely to lean on LandBridge in order to deal with produced water from New Mexico?
Yeah, I mean, that has been one of our biggest thesis from the start, right? Is taking a lot of this water out of New Mexico, where historically it's been handled in deep injection, which in our view, and I think in the regulatory body's view, that's what's causing a lot of the seismicity, and actually getting that out of basin. That's one solution, but also just spreading out that injection in whole, and having access to this large contiguous surface gives us the ability to give people like Wes, and that's a prime example with this recent deal we did with Wes, give them the opportunity to spread that injection out and bring that water from New Mexico. We've got that opportunity with every other third-party water provider out there as well.
And then just as a follow-up on that, are you seeing any change in what your costs are or what your revenue potential could change as a result of, call it regulation, legislation needs to spread out? I mean, is that impacting at all what you are able to charge per gallon per barrel? And then think about that on the revenue per acre that you were talking about earlier.
Yeah, obviously we have no cost associated with it. I do think that access to good pore space that's spread out and can be handled in a sustainable way, the price of that I think will go up over time. We have seen royalties increase over time as you have access to this pore space. So we feel like we're in a really good spot, and we continue to be optimistic as we think through adding to our portfolio of acreage, being very mindful of pore space going forward.
All right, thank you.
Thank you.
Your next question comes from the line of Sean Milligan from Janney. Your line is open.
Hey, good morning, guys. Thanks for taking the questions. On the 2025 guidance, I was curious if you'd be willing to provide any guardrails around kind of expected produced water volume growth, that's embedded in that guidance range.
Yeah. Hey, good morning, Sean. I can talk through a high level here. I think the way to think about it is, with the inclusion of the Wolf Bone Ranch acquisition, which wrapped up at the end of 2024, that'll put us, call it, just over 1 million barrels a day, kind of low millions. Through the course of the year, we've got a handful of projects coming online, two of which we've spoken about publicly, so I'll reiterate those. The first is LandBridge's construction of the BPX Kraken line that will come online the end of second quarter, and that will add meaningful volumes. And we've talked about a bit. That has been published in a press release, so I won't go over the details of that. But that's going to be fairly additive from a volume perspective towards the end of second quarter. And then the second piece is there are a number of new assets coming online on our legacy surface position that will also be used to handle Devon volumes that are flowing today that are being diverted off of their legacy position. And so, I would expect to see a pretty meaningful step change in produced water volume starting to hit in second quarter, but really fully materializing in third quarter. But I would say it's very easy, relative to the call it 1 million or so barrels a day today, to see, low to mid double digit call it growth in those produced water volumes through the course of the year and kind of exiting 25.
Okay.
Great, that's really helpful. And then on the solar side, I think previously you had talked about kind of receiving prepayments. Those had been pushed to 2025. I guess I was expecting those to sort of be in line with what the data center payment was in the fourth quarter. Is that still the right way to think about those payments in 2025?
Yeah, great question. So you didn't ask this, but I'll clarify an obvious point that the Desiree deal that we announced alongside earnings is different and additive relative to the solar opportunity we've spoken to previously. So that we are in the process of evaluating different proposals on that right now. I've spoken previously about the call it the lack of conformity around how those proposals will look. Everyone or each of these developers and operators will put forward some upfront consideration and some recurring, rent effectively. And it is our job then to go through those proposals and determine what presents the best value for the company. Now, we would expect to receive those upfront milestone payments this year. From a total size perspective, it's about, you're thinking it the right way, it's probably 8 to 10 million, this year. But I kind of caveat that a bit with what I said initially, which is, we will not favor the proposal that has the most cash up front. If we get a situation where there is a smaller upfront but a much larger residual over an extended period of time that will just generate more value for the company, we would of course go with that. But that's something that as the dust settles and we choose a path forward, I'll be transparent to the market about just so folks can adjust their forecasts and expectations accordingly.
Okay, great. But just to confirm, so the Desiree deal is separate from the prior deal that
Correct.
We talked about developing stuff. Okay, thank you. That's helpful.
Yeah, you got it.
And that concludes our question and answer session. I will now turn the call back over to Scott McNeely for closing remarks.
Yeah, thank you, Rob, and thank you, everyone, for joining us this morning. Again, we were very happy with how the year wrapped up and are very enthusiastic about the tailwinds of our business stepping into 2025. We look forward to sharing just more of our wins and successes with you through the course of this year. To the extent there are any questions or any follow-up discussions would be helpful, please feel free to reach out to contact@landbridgeco.com so we can get a call scheduled. Thanks again. We hope you all enjoy the weekend.
Okay, well, that was a great call. No big change, business as usual. Management is confident. They don't expect any scaling back of the data center project. They just continue to see more volume, more production, more cash flows, more revenue, minimal capex, more acquisitions in the future. The strategy has not changed. The guidance is the same. They just plan to continue to grow at least 20, 30 or even more % per year. The EBITDA growth is 80%. Growth in 2025. I mean, in 2024, they produced $100 million of adjusted EBITDA. So based on their guidance of having $180 million of EBITDA, you have a lot of bullishness in this stock. You have a lot of information that are bullish for this company. It was a great call, and looking forward to seeing the next one. So thank you for tuning in, and I wish you a nice rest of your day. If you like this content, I have an investing coaching program. In this program, you will learn a complete investing process. You will learn how to find good stock ideas, how to properly value stocks, when to buy, when to sell, so that you can build a strong portfolio. Additionally, you will have access to my personalized guidance for long-term results. We will do weekly calls where we analyze stocks together, and you will have access to my private number available 24/7 for full support. If you are blocked, if you have any questions, I'm here to help. Click the first link in the description to get more information. You will get a video that explains how everything works completely for free. No need to sign up, no need for your email address. Just click the first link in the description and I'll see you on the other side.